environment right now. Well, let's go across to IOC now. We're joined by the management to talk to us about how the quarter has been and, of course, what we're looking ahead in terms of quarter three. Sanjiv Singh, chairman of IOC, is with us. Morning, Mr. Singh. Thanks for joining in. Mr. Singh, dissect those numbers for us, right? What were the inventory gains in the quarter since crude prices had moved higher in the quarter, but GRMs appear to be lower?
Now, this particular quarter, we had, of course, let me start with the profit after tax. We had a net profit of 3,696 crores, which was more than the quarter two last year. Now, coming to the inventory gain or loss, we had an inventory gain of 1,056 crores this year, which was more than the last year. I mean, of this inventory gain, 932 was on account of crude inventory and 124 was on account of the product inventory gain. Coming to GRM, if we negate the impact of inventory, then the GRM was $9.14 per barrel. Even after taking into account any inventory fluctuation, the GRM was $7.98 per barrel. Now, as we all know, that GRM is a combination of physical performance as well as the margins between the product and products and crude. In terms of physical performance, the refinery did extremely well. I mean, they did better than the quarter two last year in terms of throughput, in terms of distillate, fuel and loss, energy consumption. So we are very confident that if the margins remain good, then the GRMs should remain good.
Sanjiv, in that case, why are GRMs lower than Asian benchmark Singapore GRMs also?
You see, if we talk about Singapore GRM is a theoretical GRM, which is based on a theoretical refinery, which is a simple refinery, a less complex refinery, and of course based on the fixed prices and a fixed fuel and loss. While in actual terms, our refineries are much more complex, so they consume more energy, they have a more fuel consumption. I said $7.98 per barrel because the last quarter, if you look at the last month, the prices were going up. So the impact of last fortnight inventory gain will be only reflecting in the next quarter. So if we negate that, then the GRM was $9.14 per barrel.
Right. Mr. Singh, what about Petchem margins? Petchem operating profit has also declined materially, almost half in this quarter versus last year, especially in an environment where spreads are looking fairly strong.
You see, the major reason for lower absolute margins from the petrochemical segment was the plant shutdown of naphtha cracker during this quarter. Because this was the first time since we started the unit in 2010 that we took a major plant shutdown of the cracker. And because of that reason, my supplies to the market, my volumes sold were less. And now the unit is back on stream and doing extremely well, and we are confident that we'll again do extremely well. So it was a planned activity which resulted into lower sales and lower earnings from the sector.
Also, Mr. Singh, how were the marketing margins in the September quarter? Can you highlight those for us as well?
If I remember the numbers correctly, the marketing margins were around 3,000 plus crores during the quarter, and they had been of the same level in earlier year also. Nearly, I think there was a marginally decrease of 300 crores during this quarter, and in the current month also we expect them to be of the same level.
Sanjiv, what is the GRM trend in the third quarter then? I mean, given diesel and petrol spreads are moderated, you still have some inventory gains left, right?
By refinery margin, if you mean GRM, I think they should be healthier than quarter two. Because number one, if you look at the inventory gain of the last fortnight of the last quarter, that will get reflected in the current quarter, so which will give a positive fillip to this quarter's GRM. And presently, if we look at the day-to-day GRM in the current month, we are seeing GRMs of the order of nearly $11 to $12. So we expect that current quarter should be a healthy GRM quarter.
Also, will $11 GRM exclude inventory gains?
No, presently when I'm calculating my GRM, this takes into account inventory impact also. because we are calculating these GRMs based on the actual cost of crude and the actual cost of revenue realized by sales.
Also, just for some clarity in terms of dollars per barrel, that we can relate it to GRMs, can I assume inventory gains could be around $1 to $2 barrel for the September quarter if crude prices remain at current levels?
Difficult to tell that offhand, but let me think. It may be, I think, $1 would be a fair assumption. Okay.
Also, after the end of the first half, what full year CapEx are you planning for FY18? Can you give us an update on that as well?
This year we have a CapEx target of around 20,000 crores, and we are confident that we'll be achieving that number. And we are although we have, if I remember correctly, we have done around 7,500 to 8,000 crore already, and we'll be achieving the 20,000 target for the year.
And what was the utilization in GRMs for Paradise refinery? Also, what was the distillate yields in the September quarter? In June, there was an increase in yields which aided margins, right?
Coming to Paradip refinery, the refinery is continuously operating at 100%. And if we talk about quarter two of, if we compare quarter to quarter basis, this quarter we did 3.639 in Paradip as against 1.607 in quarter two last year. And coming to the distillate yield, I have H1 numbers with me. The first 6 months, including Paradip, all the refineries put together did 78.8% distillate, which was higher than 78.1 last year. And if we exclude Paradip, we did 78.7 as against 78.4. So Paradip is at par running with any other refinery today, and the margins are also of the same order.
Also, how much of GST related taxes are still due? At the end of the June quarter, about 4,000, 5,000 crores of dues were pending, right?
If as you might be aware that there are 5 products which are outside GST, crude, natural gas, gasoline, diesel and ATF, and other products are all within GST, and which is happening smoothly. But on these 5 items we are unable to get input credit, and which is impacting us negatively. During this quarter, when the GST booking was done for the first time, based on the booking done so far, we had an impact of around 300 crores. And for the whole year, we expect this number to be somewhere around 2,000 crores on our profit and loss account.
Mr. Singh, my last question is on the petchems. You've given us an idea on the GRM trends in the third quarter. How are the petchem margins looking in the September quarter?
If you look at the trend of major petrochemical products, the trend-wise, although the margins are decent, but the trend-wise they still remain stable. They appear to be stable, so I expect that whether we talk about PTA or LAB or polymers, the indications are they would be more or less of the same level. And with our volumes going up, naphtha cracker coming up after the plant shutdown, we expect that our volumes will remain at very high levels.
Right, thanks for that, Sanjeev, and of course good luck with business going ahead. I see reported earnings, the outlook looking very strong for the third quarter, and that's the view coming in from Sanjiv Singh. The stock though trading fairly flat. We have with us Devashri Vakil, now head advisory private client group of HDFC Securities, and they've